So here we go again, market dashboard. Market reacted really negatively with the tariffs this week. Very strong reaction. We even before the announcement, the markets were down, and they were expecting, well, based on the uncertainty, and when the news came out about the tariffs on when was it? It was Wednesday night. I mean, it was way worse than expected, which explains why the market reaction was. So you see, so this is, so let me show you this without a little bit more clearly. Okay, so we see that very negative week this week. The SPY, the S&P being down 9%, the Nasdaq being down 9%. There is basically nothing green except the short ETFs, obviously, and green is the VIX, the volatility index. That's basically not a surprise at this point. So it mostly came on Thursday and Friday. Yesterday was a significant down day, -6%, around -6%, between -5.8% for the S&P, slightly more for the Nasdaq. The VIX jumping 25% again yesterday. So a very, very negative reaction from the market yesterday. So we can check the dashboard. So we see that year to date we are now down for about between 13 and 14%. We are about flat on a 1 year rolling basis. If you check, I mean, the last, we are about at the levels we were in probably May last year, I believe, just on top of my mind. We are now in, people like to mention that we are in bear market for the Nasdaq, but not yet. We are only in a correction above 10%, but less than -20% for the S&P. The important part is that the short-term volatility versus the longer-term volatility, 1 month versus 1 year, short-term volatility is twice as high as the long-term volatility, which indicates again some tensions in the market. This ratio increased significantly this week, as you can see on the S&P, and the volume as well is increasing. So a lot of activity in the market. For once, the treasuries did kind of their job, up 3.3% on the week, but not as much as you would expect in that kind of situation. So that's why earlier I mentioned that the reaction on the treasuries were positive but kind of weak, and this is not a good sign. So people are reluctant to jump into treasuries, specifically considering the debt of the US, to go behind the fences on the market, if you can say that. I think that for a reaction of treasuries to be more pronounced, we would have to see that the tariffs gamble is working, meaning that the debt will be under control. Let's say expectations that the debt will come under control with this administration. So this is where we are now. You see that the US dollar, UUP, the US dollar index is negative on this week. Again, not a good sign. Even gold was negative. And the first part of the week was pretty good until yesterday. Pretty good. I mean, it was flat plus, but yesterday was a significant down day for gold. For the reason why I don't know exactly, but yesterday really felt like a liquidation in the market, in my opinion. So we have Bitcoin that is basically flat on the week, which is interesting because what it says is that, you know, sometimes it can, you know, people consider, you know, kind of a hedge, you know, store of value. That's what I've been using it for, but very long term. It also has some feature of a risk on asset as well. But the point is that Bitcoin has a really limited correlation with everything else, basically. And when you have a limited correlation, it doesn't mean that it will move on the opposite way as some the S&P, for instance, like the risk on asset by excellence. It just means that sometimes it will move as a risk on asset, sometimes it will move as a risk off asset, and sometimes it will make something totally different or seems to be totally indifferent on what's happening beside that. So this is exactly what happens this week. Bitcoin is flat when the market, the equity market, is down about 10%. So let's move on to the next one. What did I choose to check? Yes, the equity sector. You see that all the equity sectors were down. The biggest loser was the energy sector, which, you know, is natural because all these tariffs are expected to really impact the global trade, which means that less demand for energy, and then in return, you know, weaker profits for the energy sector. So that totally makes sense. The other ones were the tech sector, obviously, where the equity indices are massively concentrated. We've seen that the S&P is going down -9 something percent over the week. So the tech sector is going -11%. It doesn't make sense. I mean, the let's say the defense sectors are doing the job, like healthcare, like utilities. Even utilities was still down 4%, but healthcare was only down 1%, something like this. But, you know, it's still a sell-off. The volatility ratio, short-term volatility versus long-term volatility, are really high at this point, and they are increasing, specifically based on the last 2 days. The volumes are also increasing, except for utilities and healthcare, which are the defense, some of the defense sectors. So everything is consistent with what's happening today in the market. I wanted to show this. I didn't put the commodities in the slide, but I really wanted to show this. You know, remember when Trump was elected? This is when we had break out of this big triangle, which on the expectations that trade would be boosted internationally and domestically by the US. And today, this week, with the tariffs imposed by Trump, we have the exact opposite. Again, an expectation of reduction in the global trade, and then consequently a reduction in energy usage, and specifically oil. And you have seen oil collapsing maybe more than 10% over the last 2 days. I don't know if I have it slightly before. So you see that over the week, starting beginning of the week in gold, it was not looking so bad. However, we are heavily concentrated in, the markets are heavily concentrated in gold at this time. You know, in the time of liquidation, like it happened yesterday, this is the kind of thing that can also happen. And it's always the same thing. When everyone is rushing to the door, there's not room for everyone. And this is where we have significant move. Although it was an interesting move, but it's not crazy. I mean, it doesn't at this time. I don't believe it breaks the trend, the uptrend anyway. Specifically, if the Trump rhetoric around tariff is continuing, we don't know exactly where he wants to go at this time, but there will be negotiations. When we talk about negotiations, this also means back and forth in terms of imposing tariffs, removing tariffs. So they will bring a lot of uncertainty on the market, and probably give some. No, I won't say it because I cannot give what can be considered as an investment advice. But the only thing that at this point we cannot say that the trend is broken. So let's move on. What do I have next? Yes, I wanted to show a little bit about the currencies, forex. You see, the US dollar is down. The US dollar is slight, not leaving the country, but you see that most major currencies are up against the dollar, like the euro, the yen, the Swiss franc, which is probably the safe asset currency. However, you have Australia, the Australian dollar, which is a commodity currency, what we call a commodity currency, that will be significantly impacted by the global trade reduction, and you can see that on the weakness on the dollar versus the dollar. Sorry. So Bitcoin I already mentioned. So you have Bitcoin and you have the rest. Today I would say that there is Bitcoin and there are not shit coins, but kind of, because if you consider Ethereum, I don't know if you've seen I don't have it here, but if you've seen the global trend of Ethereum versus Bitcoin, it's going down and it doesn't seem to stop, and it was not stopping this week. Solana was the major hit this week in the crypto space. Maybe nothing much more to add here. So I mean, this is the chart that I show about every week. Some indices compared to the S&P 500. So the SPY, the S&P, is what you see in gray, in the background, when the lines are the spread between the S&P and some specific indices, like the Qs, like I mentioned here, the DIA, Dow Jones Industrial Average, and small caps. So what does it show you? It shows you that there is money is going out of the tech sector. It's going into the Dow Jones Industrial Average, which is kind of a safer positioning in terms of equity, kind of a flight to quality at this time. And so if you have large caps going up in a flight to quality, you have also the opposite, which is so you have flight to, but you also flight from lower quality in terms of smaller caps. This is what this chart is telling you. So again, this is TLT, so the treasuries versus the stocks. We've seen that in the drop, the treasuries have recovered about 20%, I would say, from its underperformance versus the S&P. But again, this is a pretty weak reaction. This would need to be much stronger to think that at this time treasuries are coming back as a safe asset for equity. And again, I believe, my opinion is that it's still very linked to the fact that the US debt is so huge, we need to see a resolve into the US debt situation to see the treasuries coming back as a real safer asset to diversify equities at this point, which is again the reason why the 60-40 and some risk parity portfolios have been dying since 2022. And the start inflation, which put focus on the US debt, etc., etc. We've seen that quite a few times already this year and even last year. What is this? So this is, same similar chart, some assets versus gold. So you see that everything is losing, almost everything is losing versus gold. Specifically, the S&P, the Euro stocks, the ones that are often considered safer asset like the US dollar and the US treasuries are not making anything significant against gold, but this basically shows that people are leaving equity markets for mainly gold at this time. So this is the chart that we had, and I wanted to show you this chart because this one reminded me of what happened in 2008. So obviously we had something similar on in August last year when we had really significant drop on in a couple of days, where we thought that we might have some carry trade unwinding, but the Bank of Japan caved very rapidly, say, okay, we won't hike interest rates anymore. You safe, and the market went back, ballooned again like crazy. I think this time is different because there is a drift between the Trump administration and the Federal Reserve. The Federal Reserve is unlikely to be as accommodative as the Bank of Japan is for the equity markets. We will see what happens. I think there's a political, the Fed is supposed to be independent, but we all know that it's not. So we will see that if the Fed will be reluctant to cut rates, but they probably will have to if the market is going down significantly anyway. So, and the reason why I said that it looked like let's say a liquidation day yesterday, simply because almost all the assets were down yesterday, including gold. The only one was significantly positive was the treasuries, but again weaker than expected in this specific context. But we had gold going down, oil going down, basically everything was going down except treasuries, if I'm not mistaken. And the other reason why we can, it looks like a liquidation is because of the volumes. The volumes were pretty significant yesterday on the sell side. We had, an attempt for a late day rally that, failed massively, and the market went even deeper yesterday. So it was not looking good. The issue is that this is what I've mentioned the past couple of weeks, is that let me put that back. So one of the issue is that we've seen that on the previous dip, the high net worth individuals came back on the market. This is what we talked about last week. We had retail coming back in the market last week. So they were adding position and buying the dip aggressively, probably conditioned by what the Fed has been doing or since basically 2008, when they implement the Fed put, to inflate every asset and the equity market specifically and prevent them for falling. But the issue is that it might be different this time. I'm really curious about what the Fed will say and will do if it continues, because again, the market was bought on the first dip. You had JP Morgan reporting that on this Thursday, 2 weeks ago, no, not 2 weeks, 2 days ago, when the market first dipped again, you had 4.7 billion of retail investing, which was the largest level over the past decade. So the retail bought massively this dip before being hit on the next day. So we were in a position where some investor, at least retail and high net worth individuals, were in a position they were waiting for the dip to come to invest, and they did, hoping that the market would go back. Typically a martingale strategy. And when the market went down again 2 days ago, they invested again. The problem is that when you had the market going down like this, it might, spiral and, snowball effects, when you might have, specifically if these are leveraged positions, margin call that will force further selling. And the other issue is that the one that bought the dip and the market is going down aggressively, now they may want to wait for a bounce back to sell their position at the bigger price. So what this means, that doesn't mean, it doesn't say that if it will be going up or down. What it means is probably there's still a lot of volatility coming in the markets over the next week, next few weeks. So that will be very, very interesting to watch. Maybe just like 2008 was a very interesting period to experience and survive. You can survive that kind of situation in the market. Probably you can survive most markets. So that will be really interesting. So I have other things to show you. Let me check if I have a couple of questions. If you don't have questions, I will never ask you again, guys. Okay? Does it make sense? Let me check. I have what is this? I'm checking just one thing because I'm not sure that the questions are actually wrong. Whatever. We'll see. And I might be done in an hour, which is interesting. If you know what I mean. So what is this chart? Let's put myself back at the bottom so that you can see this properly. So this is the S&P since 2010, after the 2008 crisis. So we are in a drawdown slightly above 15%. I believe I said that at the beginning of the dashboard. It's about minus 17%. So where does that put us? That put us at nearly the bottom of the, controlled drawdown that I would say that we had in 2022. This would be making us midway from the drawdown we had in 2020, which was an aggressive selling in the context of the pandemic. But other than that, it puts us at levels that we witnessed in 2018, the end of 2018, very low liquidity around holiday period. At the end of the year, we had, sharp leg down and a big bounce right before the end of the year to to keep some numbers right for some fun. But it's also some levels that we had during the Asian crisis, or was it the European crisis in 2011? I don't remember, but whatever. So it's not we are not into crazy stuff already. We are in a crisis situation, which is generated by the tariffs, but we are not in uncharted territory. We are not in crazy stuff. Again, remember what happened in 2008, 2007, 2008. We had bankruptcies starting. We had, I remember, BNP Paribas closing funds at some points, and that we had banks into bankruptcy until Lehman at the September October 2008, before it unraveled until March, when the Fed said, okay, game over, we'll give free money, and that's how they stopped the bleeding at this point. So we are obviously we are far not there yet. I don't think you can say that, actually. We are definitely not there yet, but this is where we are. We are controlled fall. This is probably a term that you probably can use in when you're diving from a plane, skydiving, something like this. It's a controlled fall at this point. The only issue is that Trump has to make sure that it doesn't turn into something that is uncontrollable. Like I mentioned, at the end of the economy, this is quite a big gamble. Again, similar chart that we can see in the drawdown. Drawdowns are obviously very similar to the VIX. This is where the VIX is at this time, similar to the VIX levels that we had the recent August, that we had in 2020, the volatility spike in 2018, and all the different crises that we had in 2015, in 2011, 2010, and obviously the most recent big crisis was the 2008 crisis, what they call the Great Financial Crisis. I mean, I'm always surprised by all the fancy words that they managed to come up with. But anyway, again, comparison since 2020 between the S&P and the VIX. The VIX, just to show you, I mean, the spikes, the drawdown, I mean, probably nothing much more to see here. That now gets slightly more interesting, because that's the activity indicator based on historical volatility and the volume. So we see that the volatility has spiked quite significantly or this week, and specifically over the last 2 days after the tariffs. The volume didn't as much, but the volatility spiked. And the bigger issue is that specifically for volatility adjusted strategy, volatility spiking again like this means that it will probably trigger some reduction position for long long equity risk adjusted strategies. So that is something to monitor, and basically that's what I'm showing this. It's really a theoretical exposure that a fund that would implement risk parity on equities would have. So we see that on the first drawdown, we had some volatility increase that led to some selling pressure, meaning reduction in exposure for this type of fund. Now, what happens is that with the volatility spike over the last 2 days, and specifically yesterday, another increase, significant increase in volatility may trigger, or probably will trigger, for the remaining long equity strategy, reduction in exposure, so more selling pressure. So I think that on Monday might be quite interesting. Monday might be quite interesting for one specific reason. This one specifically, we might have more deleveraging in equities than we experienced before. So further pressing seller selling pressure. Sorry. So more selling pressure coming from the increase on volatility if you want to control, for those strategies and for those investors that want to control their risk. We might have some selling pressure coming from margin calls after Friday. And all the retail buyers that came in the market, especially buying the dip, we will see that if they are panicking on Monday, or if the market is, take his mind back and try to say, okay, this thing is not over, we need to wait and see what will happen. But Monday will be very interesting to monitor, to see if that escalates into something less controllable, if retail panics, if we have margin calls, or if we still have some risk-adjusted investors that need to adjust their position to the risk, meaning reducing their equity exposure.